Hello, greetings, and welcome to Dividend Blasters. We're going to discuss the power of the drip, the dividend snowball, how to accumulate millions. Before we start, I would kindly ask for you to give this video a like and subscribe to this channel, Dividend Blasters. Quick disclaimer, I am not a financial advisor. The purpose of this video is for information and education. It reflects my own personal opinions. I have been an investor for more than 30 years. However, I have a licensed professional financial advisor that I consult before all major financial investments. So I urge you, please do your own research and consult a financial advisor prior to making any major financial decisions. The dividend snowball, drip, drip, drip. Drip is dividend reinvestment planning. So the way this works is when you go ahead and invest in a company that pays dividends, the best approach, if you can, is to reinvest those dividends, 100% of them, each and every quarter or every month, depending on the rate of payment or frequency of compounding. Reinvest it. As you reinvest it, you're growing your holdings. That reinvestment is buying more shares, it's increasing your holdings. So the next cycle, when you get a dividend payment, it's going to be a bigger dividend payment because your holdings have gotten bigger. So your payment's going to get bigger. You are then going to go ahead and reinvest that dividend payment back into your holdings. And as your holdings get bigger, your next dividend payment will get bigger. That's how this goes. That's compound interest. Every time you reinvest, you're buying fractional shares of your holdings and you're growing them. So they're going to generate larger dividend payments. Um, Always try to invest in companies or ETFs that have a growing dividend growth rate. So you want to invest in a company that's increasing their dividend yield each and every year. You want a growing dividend. That's extremely, extremely important. Now, I'm going to walk you through a couple of dividend growth models. Well, actually, it's one model, and I ran three companies through it to demonstrate to you the importance of a growing dividend yield or an increasing dividend growth rate, if you will. But I'm also going to show the importance of continually investing additional funds into your holdings. So the first one is AbbVie. Now I have a simple model and I have a handful of parameters, and I'm going to flash some screenshots from my model. There will be another video where I actually walk you through the model, but that's not today. It'll be another day. AbbVie, ticker symbol ABBV, stock price 151.31. We're starting out with 42.41 shares. We're going to drip 100%. Yes, and it's a quarterly drip. But we're also going to invest $7,500 a year. So that comes to a little more than $600 a month, a little more than $150 a week. We're going to do that over 30 years. We're going to assume annual price appreciation of 3%. Now, can we expect that? I think that's a conservative estimate. Um, I think that if you look at history, we've had many years where uh, big companies like AbbVie, which is a big drug company, very successful at paying dividends, um, have had years where their prices appreciated significantly more than 3%. You can also find a couple years here and there where it has gone down, and people with investments in AbbVie may have lost some money. Um, but that's a year or two here, a year or two there. A lot of companies had negative rates of return in 2000 during the dot com bubble bursting, as well as in 2008 with the subprime mortgage crisis. But they tend to come back. That's what I'm betting on. So, couple of key variables here that I want to talk about. And I've talked about these a lot in the first 8 videos, is the dividend yield of 3.91%. That is a really nice yield. And what I really like is the dividend growth rate, 9.16%. Um, this is what I like to see, and it's an increasing growth rate. What this means is that on average, they are increasing their dividend yield by 9.16% every year. Now, this metric that I have, and I pulled a lot of this information from Seeking Alpha, which is a wonderful resource. I'm using the 3-year dividend growth rate, or the CAGR, or the CAGR. I call it the CAGR, the compounded annual growth rate. I could have used the 5, and I typically like to go to the 5, but I use a 3 because it's a smaller number. I want to be a little bit more conservative. I'm not trying to inflate anything. I'm really trying to make a point here that uh, having a good yield and an increasing dividend growth rate is absolutely critical to growing your portfolio, building wealth, becoming financially independent, doing it over a long duration, which is how dividend growth investing works. Um, that coupled with having an annual contribution, and I'm using $7,500. I have another variable in here, a tax rate. So even though you're getting an annual dividend payment, or here you're getting quarterlies, you are going to have to pay tax. As long as we have government, we will have taxes, and they like to tax dividends. And the going rate for dividends is 15%. All right, let's take a look at the model. Okay, so here's the model. I have several columns here: year, shares owned, annual dividends per share, annual dividend pre-tax, the dividend tax, the 15% that will come out and go back to Uncle Sam, and the annual dividend post-tax. The frequency of compounding is quarterly. I want to say that in my model, I don't have quarterly compounding. I'm just doing simple annual compounding. That takes a little bit more complexity, and I did not work that in by design. I'm actually planning to do that in another video, but I wanted to disclose that. You're not going to see huge difference here, but you will see a difference, and I'll explain that in a little bit. We have the portfolio balance with that first drip, and we have the let's see, yep, and then we have the portfolio balance after the drip. Okay, so we have our annual contribution, and then we have the sum total of what's going in to the holdings. Okay, we have the drip, and we have the $7,500 going in. So that first year, we're contributing $7,713 after tax. So it's a 7,500, and let me be really clear: the dividend that's going back in is $213. It was 250, less the $37 in tax. You can see that right on the first line is 213. So 213 and 7,500 is 7,713. So that combined with the portfolio balance will increase our holdings to 14,322. So one thing I want to make really clear is that we are dripping and we're investing. And the drip is, let's see, 250. So we're probably getting about 6 shares out of that drip. We're increasing our holdings maybe to 48 or 49. And then we're investing another $7,500. We're going to get another 49 and a half or 50 shares uh, out of the 7,500. And so we're going to increase our holdings from the 42.41 where we started at the beginning of year one. We're going to end up at the end of year one with about 91.9 shares. And that's going to translate to about 14,322.84. This also includes the price appreciation. I kind of glossed over that, but if you look at the white column right after those two blue columns in the middle, we started out with a price of 151, and then with the 3% presumed appreciation, it's going to be 155.85. How does that affect this? Well, guess what? With price appreciation, our holdings are going to go up in value, which is nice. But as we drip and as we buy, we're going to be buying less shares, but we're going to be buying fewer, more expensive shares. So think about that for a bit. It's all good. You're not losing. You're doing well. You want it to go up. Obviously, I don't. What I have heard folks talk about. Well, they don't like their holdings to go up because then they're buying fewer shares. I like to buy and continue to buy, but I also like my holdings to go up, and I like them to split. And that's another video, but we'll get to that later. So I went through year one, uh, field by field. Now I'm going to focus right now on the last field, portfolio balance. Let's go to year 10. So we're going from the end of year one, where it's about 14,000. Year 10, we're going to be at about $120,000 portfolio value. Now remember, we've invested 7,500, so that's about $75,000. But let's kind of take a little bit look about how much we're dripping. So in year 10, we're starting to drip $5,800. And the drip is going up nicely. It went from 4,700 to 5,800 between years 9 and 10. This is after tax. And remember, that first year we were only dripping $213. But why are we dripping more? We're dripping more because we're increasing our holdings. We're putting $7,500 a year in, and we're also getting an increasing dividend. So these are all very important variables that are going into this. Year 15, let's look at the portfolio value. It has actually gone up to $237,000. So in 5 years, it went from 120 to 237. Year 15, we're now dripping 15,500 and looks like $99. So we're actually dripping more than we're investing. So, and I don't have the yield on cost metric calculated. I'll do that in another video, but the yield is going up. We're getting more back than we're putting into this. This is the dividend snowball, and I'm illustrating this for you with the numbers. Let's see, let's go to year 21. Year 21, our value of our portfolio is 536K. And again, we are, how much have we contributed? Well, we've probably contributed 20 times 750, 150, probably about 157K, about. And we're dripping after tax $49,000 and some change. Looks like 49,451. That's in 1 year. So think about that. You're 21, you're going to be getting passive income over $49,000. This is the snowball. This is dividend growth investing at its finest. This is what you want. Let's go to year 30. Let's just cut to the chase. So, uh, the portfolio balance at year 30 is 2,408,000. That is a sizable amount. We are dripping in year 30 after tax, and it's that third blue column, 300 and 365. Looks like, if I'm reading it, I'm sorry, it could be 350. I think it's actually 355. $355,000. Wow, that's a lot of passive income. Okay, for sitting around just investing. Now you're just getting passive income, and you're continuing to grow your holdings. Now, listen, after 30 years, hopefully you're retired and you're starting to draw down some of this, enjoy the fruits of your investing labor. That's what I would be doing. That's my plan. If you look at annual contributions, so go to the right, the first blue column, but in the middle, um, after the three mustard color columns, you've contributed $225,000 each and every year. That's come to about 225. Your annual contributions and your dividends total reinvested are about $2,005,000. So you're dripping significant amount. Do you know how much you're dripping? Go to the third blue column. Go to the left. You're actually dripping after tax total over 30 years. You've dripped 1.78 million, significantly more than the 225 you've invested. That is an absolute thing of beauty. How did you do that? Well, you helped grow your holdings significantly by the $7,500 a year, but you dripped. Okay. You reinvested your dividends and you grew your holdings and you grew your dividends and you grew your holdings and you grew your dividends and you've created wealth. That's how it works. Couple graphics here. You can see the upward arcing of the portfolio balance of the drip. So in year 10, you're at 120. Year 20, year 20, you're at 465. Year 25, you're at 986. So right around there, you're going to get close to $1 million just with this one stock. And then by year 30, you're going to be around 2.4 million. Now, earlier in this video, I mentioned that I did not apply quarterly compounding. I applied simple annual compounding, but this is actually compounding quarterly because you're getting a dividend payment quarterly, and therefore you're dripping quarterly. So, having said that, the balance on your portfolio is going to be a little bit more than 2,408,000. I did a calculation and kind of a quick back of the cocktail napkin calculation, and it came to about 2.7 million. So 270,000, $285,000 more in the portfolio balance. That's a sizable amount. That goes to show you the power of compounding interest. Annual dividends, okay, and what I'm showing in this next panel here are pre-tax and post-tax. Pre-tax at year 30 is going to be about $418,000. And there, the number that I couldn't see previously in my model, post-tax will be about 355,000. So you will be paying, how much is that? About $63,000 in taxes on dividend. You know what? If you're pulling down $418,000 in passive income, I'm totally fine paying $63,000 in taxes. Yeah, I'd rather not pay any, of course. I am someone who likes less taxes, but it's a lot of money. So you're doing very well. Okay, I have another one, Verizon. And the reason why I'm showing you Verizon after showing AbbVie is that Verizon has a larger dividend yield. Okay, AbbVie was like 3.5% and had like a 9.5%. I'm testing my memory, 9.5% dividend growth rate. Verizon's a little different. It's a cheaper stock. It's a wonderful stock. I've got shares of it and I love it. Um, their yield is higher. It's more than 6.5%, but the dividend growth rate is smaller. It's 2.01%. If you take the two, it's less than 9. It's not much less, but it doesn't have a larger dividend growth rate. It's got a smaller dividend growth rate. I typically like to see something um, bigger, but they pay a higher dividend. So just some of the variables. The stock price is 40.22. This is just as of last Friday. February 17th, 30.22 shares. We're going to contribute again $7,500 over 30 years. We're going to contribute $7,500 annually each year over a period of 30 years. Uh, we're going to assume annual price appreciation each and every year of 3%. Quarterly dividend, we're going to drip 100%. I just talked about the two dividend metrics, and we're going to assume a 15% tax rate. Okay, so here's the table. We are starting out with, in our first year, we have 30 shares, $2.63 a share is what comes out of that 6.5% dividend yield. That first year, we're going to get pre-tax 79.61. After taxes of 11.94, that's going to come to about $67. Our portfolio balance is 12.15. All right. And then with that first drip, pre-tax, it's 12.95. After tax, it's going to be 12.83. We're then going to contribute throughout the year $7,500. Okay. So the $7,500 contribution plus the drip, we're contributing about $7,567.67. So you see what I'm doing? I'm adding the 7,500 to the 67.67. Together, we are acquiring about 182 shares. So we're maybe acquiring 1.25 share with that first dividend payment that we're reinvesting, but we're acquiring about 180 shares with the $7,500. So 182 shares are acquired. Uh, this is all going on while the price is going up 3%. So the price goes up from 40.22 to 41.43. Our total number of shares is now 212.90. So we're working hard in the beginning just to get our holdings up. And this is how we grow our dividends. And as you go down through the 30-year time horizon, you're going to see at some point, and I'll show you, that your drip is going to start to outpace your annual contribution. Let's take a look at that. Let's find that. So again, we're contributing $7,500 a year each and every year. Over 30 years, it's $225. Let's go to the third blue column. We want to see where the drip starts to outpace. And I look and I see that in year 14, the drip is going to be $8,164. So after 14 years of investing, we're going to start to go ahead and get a dividend payment greater than what we're contributing. Okay. And let's see what happens in year 14. Year 14, I see our portfolio value has gone to $166,263. Pretty doggone good. And I would say that that's after maybe contributing uh, 75, maybe $115,000. Okay, that's not bad. That's not bad. You have to do it. You have to put the time and the money in the beginning to grow it. But after a while, your dividends are going to start to outpace your annual contribution. Now, let me just say this. At some point, you may want to say, "Hey, you know what? My dividends are doing great. I don't feel like contributing the 7,500." You can do that. You can do that. If you put the money in and you want to just let the drip grow based on your what you've invested, you can do that. But you won't get to the number that we have down here. It'll be a lesser number. So there is a trade-off. And what I learned in graduate school in economics was that's called the marginal rate of substitution. You're trading off one thing for another, and you have to assess what the utility of trading is. And anyway, that's another video, and I probably won't even get into that. It was a long time ago. So let's take a look at let's see what happens in year 21. Year 21, and I'm going to 21 because it kind of stands out. We're going to be, it looks like $417,000 in dividend value. Am I looking at the right number? I'm looking at year 22. Well, then we're going to use year 22. I'm going to change the rules here a little. And we're going to start dripping over $18,000 that year. That is significant. That's more than 2.5 times the size of the 7,500. Absolutely astounding. And look at year 22. You were going to start to acquire more than 300 and looks like 320 or 330 shares of Verizon. So here you're growing your holdings, so you're going to be growing your dividend. It just really starts to quote snowball. That's your dividend snowball. And then let's go to year 30. Year 30, I'm projecting with all these variable assumptions that I put in here that we're going to be at around $813,000. So we're contributing $225,000, but look how much we're dripping. We are dripping more than that. We're dripping 353,000 total uh, after tax. Not bad. Not bad. That drip is fantastic. It's a thing of beauty. Let's go to the panels. You can see the graphs. So you can actually see here in year 10, we're starting, I think we're at around a little under 7,000, but we're going to 120, 112K, and then year 20, 347, and then 541 in year 25, and we're ending up at 813. The annual dividend payment, which you're going to drip, will end up in year 30 of $31,639 after taxes. Not bad. Last one, and I wanted to show this because this is Microsoft. Microsoft is a marquee technology company. They are a growth stock, but they're also a dividend growth stock. They've been increasing their dividend for 18 consecutive years. They're expensive, 286 bucks. Let's presume we're starting with 4 shares, so maybe it's about ooh, 1,300 bucks or so. Going to invest $7,500 each year for 30 years. We're going to assume price appreciation of 3% each year. Here's the two metrics. The dividend yield is a small, modest 1.05%. However, the dividend growth rate, 10.25%, or 10.25%. Again, I'm just using the 3-year growth rate. The 5-year was higher, but I wanted to use something more conservative. And the tax rate is 15%. So looking at the model, okay, we're starting out with 4 shares and we're at $1,144. Okay. And our first dividend payment in year one is going to be $10.21 after taxes. So we're going to add that and we're going to end up at 1154.45. Okay, after that first drip, we're going to contribute 7,500. So together we're going to increase our holdings by the sum of those two things, $7,510.21. Price will go up 3%, about $8 from 286 to 294. Through all that, we're going to increase our holdings by 25 and a half shares. So we're going to go from 4 to 29.49, and our portfolio balance will increase from what started at 1144 to 8688. So we're going to continue to do this. Okay, we're going to put in our 7,500 a year. We're going to continue to drip, reinvest everything back in the holdings. Let's take a look at year 10. Year 10, we're going to be at $93,000. Okay. And so year 10, we've invested 75,000 and we've dripped at year 10. We're dripping annually about $1,350. It's not bad. I'd like to see more, but it is what it is. Okay. But look, it's going to start to get bigger. Year 15, you're going to start dripping post tax 3,300. All right. And your balance is going to be at $160,000. Okay. Let's go all the way to year 30. Year 30, you're going to end up at about $653,000. So you basically contributed 225,000, but you've dripped 248,000. So at some point, and it took a little bit longer, it looks like in year 20, the drip actually began to encompass and overtake the um, the amount you're contributing, the 7,500. So in year 20, you dripped $7,605 post tax. So it's about $1,500 more than you're contributing. And then look at that. It kind of starts to multiply significantly, goes to 8,900, then to 10,400, then to 12,200, then to 14,000, then to 16,000, and then to almost 20,000. And in the end, at year 30, you are dripping $37,000 into your holdings. So in the end, you've dripped 248,000. You contributed 225,000. Everything that's been reinvested total is about 473,000. You're ending up with $653,000. Let's take a look at the graphic. Here's the graphic. So year 10, you're at around 93. You go to 256, you're going to end up at the 653 in year 30. Now, again, I didn't do quarterly compounding interest. I did annual compounding. Okay. It is a little bit different. I am fairly certain that it's more than a couple 100,000, but it is what I'm doing here is I'm illustrating for you the power of compounding interest. So uh, with multiple compounding factors. So quarterly, but you're also compounding each and every year your dividend and your continual investment of the 7,500. You are growing your holdings. Let's take a look at the annual dividend or the drip after tax year 30. See how it really starts to arc up around 20. It's kind of slow, kind of flat for the first 15 years, but then it really kind of shoots up parabolically um, around year 20 and year 21 with the dividends. It starts to do that as well with the holdings right around that time. But it's very dramatic with the dividends, the annual dividends. Key takeaways. key takeaways are to invest in dividend growth stocks that have a history and a practice of increasing their dividend. Also, you got to start early. You need that time horizon. You need that 30 years or 20 years. So if you're right out of college and you're just starting out, you need to start doing this and start contributing as well. Contribute as often as you can and reinvest your dividends 100%. Drip, drip, drip. Folks, I want to thank you for sitting with me through this video. I hope you found it informative and educational. I would kindly ask for you to give this video a like and subscribe to this channel, Dividend Blasters. I wish you a great day and God bless.